4 months ago, we saw this signal suggesting house prices could rally. Here's a short clip.
So a signal occurred. So every time this has happened, house prices have increased.
And whilst we haven't got the information on what has happened to house prices yet, our favourite housing stock has rallied since this signal had flashed. In addition to this, if you scour Rightmove and speak to real estate professionals, you would realise that houses which have been stagnant or sat on the market for extensive periods of time have now actually sold. And of course, we filled this gap which we were speaking about earlier.
This is actually a gap which I hadn't noticed before. And these gaps have higher probabilities of being filled, which coincides with...
We have now filled this gap. I didn't have time to make a video, unfortunately, but I did post on LinkedIn that depending on what happens around this area will tell a big story. And for those that are interested, we didn't get a weekly close and we saw a couple of indicators suggesting this move still had momentum. And if you would like to know what indicators they are, like this video and comment indicator, and I will touch on the green arrows as well, which indicator was used to distinguish when this pattern or these indicators flashed. And here's another coincidence for you. I'll insert a clip here.
The level to watch out for would be around here at one point, or terrace houses to scale. Around this mark anyway, because then that looks like a Wyckoff schematic, and then buyers could come back in potentially here. It breaks these support levels, everyone sort of gets flushed out.
So we suggested that it would be around this mark that interest would come back into the markets. And around this kind of time, or this time exactly, I know this hasn't been updated yet, however, this interest has come back in and it is backed by the movement in these stocks. And whilst we're here on the Savills stock, if you remember in a previous video, I won't keep uploading these clips, that we took this move here and we projected it forward to today. You can see the correlation between this move. Of course you can move it about a little bit, but it is pretty accurate, all things considered. Just looking at this fractal, it would suggest that the real danger, the real crash, comes when Savills stock falls under this level, which would make it very similar to what happened in 2006, 2007, when it fell under this level. Yeah, that's when house prices started to roll over. The good news here, however, is when this happened was June 2007. If we look, I know we're on Kensington, we'll look at London in a minute. House prices rolled over, and it took about 5 months before house prices took out those levels. It stagnated and went sideways. And of course, the Federal Reserve did cut interest rates then as well. So what's important to note here is the month of August. The markets typically do take a nosedive around this time. So if we compare these moves again, if we imagine that because these patterns often occur, it was 9 months to the top and 12 months from the low to take out that previous low. So here, 9 months to the previous top will take us to September 2024. 12 months to take out the low. So that brings us to a period between September and December of this year. And if we look at the federal funding rates as well, let's put this on top of it actually. The 2008 housing crash, the Federal Reserve paused interest rates for about a year, about 12 months. And then 12 months takes us to, coincidentally, August again. So judging on all of these patterns and these coincidences, we can imagine that house prices, whilst they are technically up, and are probably recovering some of this drawdown, particularly in Kensington, Westminster and Camden. It might retrace some of this move, nevertheless could still start to roll over come the end of 2024. And if we go back to what happened to house prices around this sort of time, we had 5 months, didn't we, before house prices took out, like, say, resistance levels or fell below the current level. So what I mean was, it happened in August 2007, and it took 5 months to take out £297,000, yeah? However, it really started to fall about a year later. So if we imagine this, December 2024, I'll take this fractal again now because I've deleted it. But essentially, it would correspond with the 18.6 year real estate cycle. Because we had the 89 crash, 18.6 years later, takes you to 2007. And 18.6 years later after that takes you to about 2025, 2026. And with all of this in mind, and we have seen the coincidences and the patterns today, it's unfathomable how everything ties in together, whether you want to believe it or not. But of course, the most important factor is the federal funding rate, because this reacts to everything that's happened within the economy. And we are at the business end of the cycle. And when house prices, right, it'd be interesting to see when this page gets updated to see what happens if this is turning back up once all the stocks did. I imagine it will. And confidence should re-enter back into the market, because this was like a 30% drop. And if, like, let's say for example, hypothesize here, and house prices go back up to all-time highs, which is a possibility, that increase is nearly 50%, right? Say 40%. And could you imagine the headlines if house prices rose over 40%? I don't believe I touched on this, so we'll go back to it. So around this mark, I mentioned about the weekly close, and depending on what happened would suggest that house prices, or at least this stock, can continue to rally. Is if you compare these two indicators, for example, you have this move here and you have this move here, right? To the untrained eye, that might look very similar, but as you can see, this is a 5-wave move upwards, whereas this is 1, 2, 3. This is 1, 2, 3, 4, 5. Right, so this suggests that this move has higher momentum and there's emotion behind this move, right? So people are buying into this move and it's authentic, it's real. You can have a higher certainty that what the charts are telling you is truth. And by the time this happened, I sent out another post on LinkedIn, because unfortunately I couldn't make a video at the time because I was rather busy, saying that if you have to purchase in central London, now is the time to do so. Or alternatively, if you're looking to sell, this could be your best opportunity yet before house prices inevitably roll over. And whilst this fractal here, I've deleted it again. Right, so whilst we have this fractal here, suggests that it could be prolonged to June 2026, it's important to remember that all of these markets, or everything that goes on, is based on monetary policy, right? This is what's most important. And there's a huge argument that the Federal Reserve started hiking rates too early, or too late, sorry. So they started to hike these rates far too late. The price action for this to happen only took a year. So it rose up 50% and then down 34% within that time, within a year. So if we do the same here from this low, let's go down to this so it clears it up a little bit. We're already up 58%, and it can crash back down to these levels in just a year. So if we are going by the similarities, by the time May rolls around next year, would be the time that you want to be out of markets completely or stop buying those times, because it would be far too risky looking at all of the information and coincidences or patterns that we've looked at today. So let's say, for example, refurbishing a property takes 3 months. There's plenty of time to purchase a property, renovate it, let it out, refinance before everything, cascades into one of the worst depressions you've possibly ever seen. There's also the possibility that house prices go parabolic and something like this happens. However, we have to consider that we are too far gone in the economic cycle, right? Interest rates are nearing their cut. They're nearing the end. They're nearing the pitfall. And one thing I saw recently, which is quite fascinating actually, is that UK bankruptcies are where they was at in previous recessions, which is crazy. So whilst house prices may recover a little bit, I can't see that parabolic move happening in the UK. However, if we look at divergences, we did have a clip about this beforehand. Just bear with me. About home builders versus another home builder ETF versus Savills. We spoke about this divergence that was happening around about here.
So you have the home builders ETFs. They look somewhat similar. And if we look at Savills stock on top of this too, you can see we've got a huge divergence here. And although the UK is technically in a recession according to a few indicators, America isn't yet. And of course, America has more gravitational pull because it's a bigger economy.
And we said last time that so Savills is the blue stock here, that last time when Savills was going up, it was incorrect compared to the home builders. And the same thing has happened recently, because obviously America has more gravitational pull because they have the best currency of the world, right? Boring stuff. If we look at another example for divergences, we'll go over to Bitcoin, because I know a lot of people like talking about this. Let's clear this up. So as you can see, this low was taken out here by Bitcoin. However, Ethereum, which is a good thing to use for divergences because they're the top two in the crypto world. Whereas Bitcoin closed below, Ethereum didn't. So this bounce back could have a higher probability of happening, or something's incorrect, right? So one of them's wrong. I won't go into too much more stuff because it's important to touch back on what we've seen here today and the coincidences, because you have to realize that these patterns occur naturally in nature, right? And these markets are driven from human emotion, human sentiment, and not any fundamental thing. Because, let's look at this basically. So if we look at house prices, London, right? Let's look at London rents quickly. This property here, £3,683. This property, right, should be worth £883,920 if you're looking at it from a rational point of view. The last one was a 2-bed house. So renovated to a sort of standard property. And this is a flat, 2-bed flat. Renovated a little bit nicer, but you can see it's 1.8 million, and this property in a rational world is worth £880,000, whatever it was, and this one's asking for £1 million more. So it just goes to prove there's nothing rational about markets. It's all on emotion, on fear of missing out, fear of prices going higher. Yeah, that says 1,000 words there.